So market structure is simply the basic building blocks of the market, right? So it's just the simple layout of how the market is built. I normally say the market structure is simply the language of financial market, right? So that means as the market is moving, it is communicating to traders, and traders are understanding the prices as they are moving up and down, right? So traders are looking for lower prices so that they can do a buy, and of course high prices so that they can do a sell, right? But guess what? If the market is giving you low prices and you don't really understand that it's giving you low prices because you don't understand the basic building blocks, you don't understand the structural analysis of the market, then you're not going to make profit on the market, right? You'll not do well. So understanding the market structure, right, gives you an edge on the market. So quickly on this video, I'm going to just show you how to understand the basic building blocks, how to understand the structure analysis. This is structure analysis 101, right? I'll try to keep it very, very simple. Please, if you're just joining me on this, if this is your first time you're joining me on this channel, please do wait to like and subscribe, right? And of course, share the video, okay? So welcome once again. So let me start with by just drawing and showing you how the market is formed, right? Or how the structural aspect of the market is formed. So let me start with this. So let's say the market is trading to the downside here. So it pushes down, right, or it moves down. This movement downward is called an impulse, right? So it gets to a particular level, it stops, right? And then it pushes upward. So this movement upward is called retracement, right? It's called retracement. So again, it pushes down again. So this movement downward is called impulse. Now, while going down, it has to go lower than this low, right? So immediately it moves lower than this low. So this level becomes our structural low, and this level becomes our structural high, right? So the movement of price, if you notice carefully, you notice it is this high that moved down to go lower than this low. So it is this high that broke this structural low, right? So once this high breaks this structural low, we call that a break of structure, BOS, break of structure. So let me carefully, okay, I'm going to paint that later. So that's break of structure. So once there's a break of structure, the price can still move down a bit more before it goes to another retracement. Okay, so it goes to another retracement, something like this. It retraces us upward again. So this becomes the new structural low, right? So this is a low again, right? And this is the high. So again, it pushes down again, something like this, and then it forms another high. So you notice the way this high was so careful not to go higher than the previous high. So this is a structural high, and this is a lower structural high, and this is a structural low. This is a higher structural low, not to confuse you, and this is a lower structural low because this one is lower than this low. Okay, that's fine. Now you notice that the break of structure is happening to the downside. Let me paint it out. Let me use this color for my break of structure. Let me use this color. So you notice once the price moves lower than this structural low, we call that a break of structure, right? So that's a break of structure there. So that's the break of structure there, right? So immediately this price move lower than this low. That's the break of structure to the downside, right? So again, we have another break of structure. So you notice it is this high, it is this high price that broke this structural low. So immediately this high price becomes our strong high, if you like, our resistance or our verified resistance. That means it is a point where it will be difficult for the market to just break through. So let me draw this at this top here. So this level here becomes our structural uh, strong point, right? So that means it's difficult for the price to go above this level. So the next time the price moved down again, you notice it went lower than this low. So it broke structure again to the downside, something like this. So it broke structure again to the downside, right? Excuse me. So it broke structure again to the downside. Okay, so if you notice, the break of structure is only happening at the towards at the downside, right? So it's not happening at the up. Now this is what I mean. If this price should move up and goes higher than this structural high, it has broken structure to the upside. But for a downward structure or for a downward trend, the structure should only be breaking towards the downside. That's to show that the market is going down, right? The market is going down. So after that, after this break of structure, there will be a rally to the upside again. So you notice the price will not have to move to go higher than this high, right? It will try to maintain this high or respect this high. So that means there is a liquidity here it has to respect. So it is only taking out the liquidity at the lows and then protecting the liquidity at the high. So once it move up like this again, the next time this will be our target point, right? Our target points. Okay, so the next time it moves down again, so it will move down something like this again. So something like this again. So once it goes lower than this low again, that becomes, don't forget, that becomes our break of structure. So let me paint it again. So this becomes our break of structure. So this becomes our break of structure, right? So you notice that the market is going down, it is breaking structure towards the downside. So this is what we call downward trend, and respecting or protecting all of these structures at the upside, right? So this is what we call downward trend. So when you see this, it means the market is going down. That means you want to look out for sell opportunities, right? So where do you say you only want to sell when the market gives you a premium price or a high price, right? So, and high prices are characterized by a retracement to the upside. So, if this market retraces towards the upside, okay, now number one, it has to move higher than this break of structure. And of course, if you put your Fibonacci retracement, so this is the total leg from here to here, can be seen as 100%. So, it needs to move above the 50% of this total leg. So it has to be above this level, right? To be on the safe side. So a retracement like this towards the upside, sorry, a retracement like this towards the upside, right, is the kind of retracement we are looking for. So immediately it goes above this level, this break of structure we experience here, right? And of course, it's already above our 50%, right? So it has reached our preferred point of interest where we wish to enter the market again. So anywhere around here, we can enter the sell anywhere around here, right? So why anywhere around here? Because we know that this area up here is the protected level, right? Where the market has been avoiding, right? Or the market has never gone to that area. So that's where we can set as our stop loss. So the trade can start. Okay, let me do this quickly. The trade can start somewhere around here. Let me do a rectangle. The trade can start somewhere around here. Then our stop loss can be above this level. So let me use a line for that. So the stop loss level can be above this level. Why? The reason is that area has been serving as our protected level there because the price has not been able to get there. So it's a sell around this area, right? So hoping that the price goes down again. So if the price moves down again, and of course you'll be in profit, right? So if you're selling, if you're selling at this point, right, your take profit should not exceed this structural low, right? Because this structural low, once this price comes back to this level, it will be seen as a double bottom. This is what I mean. When they are equal lows, it will be seen as a double bottom. And generally on the market, when traders see double bottom, they want to jump into the market to buy because double bottom is seen as a support, right? It's seen as a support. So that means there is a high probability that the price can shift right to the upside. I mean, the price can start trading towards the upside. So before that happens, you want to make sure that your take profit is below or above this level, such that you must have taken your profit and knock you out of the trade in profit, right? Before that happens, okay? So let me say the price can get to somewhere around here, right? Giving you relatively equal low. That is EQL, relatively equal low, and then the price can from this level uh, start pumping towards the upside, something like this, right? Something like this. So it must have it must have hit your take profit level already. It must have hit your take profit level already. So that means your take profit will have to be just a little bit above this level, right? So you notice this price here, the movement of this price down here should have hit your take profit, and then you are out of the trade. Okay. All right. Now, one of the scenario that happens again on the market is for the fact that the market has painted for us or have printed for us a double bottom here, or relatively equal low. So most traders will just conclude that is where the market is going to turn, forgetting that we are already riding a downward trend. This is a downward trend here, and on a downward trend, you want to look for opportunity to sell. That's how to be safe on the market, right? And to reduce the risks. So it means with this double bottom, traders will start pumping in with buy, buy, buy. Of course, it move up, right? But that's price moving to the upside. It doesn't mean that the trend has changed, right? Because we have not seen a shift, right, in the character or a shift in the direction of the market. Okay, so and remember also whenever the market prints double bottom, since the market already knows that new traders, right, or majority of traders, retail traders will be looking at buying. It means as they are buying, their stop losses will just be a little bit below this double bottom. So that means there is enough money or there is enough liquidity under this double bottom. Guess what? The next direction the market will go. Remember, following up this downward trend, this level is protected level. The next direction the market will go to, the market will always be attracted to double bottom. So the market will quickly go down and take this trade out, right? So this is where our stop losses will be. So that's what they call stop hunt, right? So since your stop loss is here, the market will quickly come down and stop you out and still move down. Now, it's not that the market is anybody is watching you. No, it means you enter the wrong trade. That's what it means, because you did not read the market structure. Remember, I said the market structure is the language of financial market, right? So there was no need of entering a buy trade at this point and putting a very tight stop loss, knowing that you're trading against the market, right? You're trading against the market, so the market will knock you out and of course still go down. It means this lower point still remains the the target point. Remember, all of this low break of structure at the low side is the target point. So this is only a very small manipulation of the market, right, to induce buyers and of course take them out. Now, but for professional traders, for experienced traders, they will still read the market structure and say, no, this market is still going down. I should not take this double bottom, right? So that's how you trade. Now, remember, now that it has traded to the downside, there's already another break of structure. Don't forget, there's another break of structure again. So since there's another break of structure again, so at this point here, there is a break of structure there. Okay, there's a break of structure there, right? That's a break of structure there, as you can see. So the market is still going down. The whole market is still going downward. So this is still the same break of structure going down. So as long as the break of structure is happening at the or is taking out the lower structure, right? I mean the break of structure is taking out these lows. We are still down, going down. So you should not be buying, you should only be thinking about selling for a lower risk, right? For a lower risk, for a lower risk. Selling for a lower risk. Now there can be a higher risk trade, right? By trading this retracement to the upside. So that is you taking a trade with a higher risk. But guess what? You are not advised to take a trade with higher risk. You are advised to take a trade with lower risk, right? That's how to trade long on the market. So after this, it will experience a retracement to the upside again. So let me now show you how the market normally shifts, right? how the market normally goes through a shift. We call it change of character, right? It shifts. That means it finally reverses and start trading towards the upside. Okay, so as long as we are having these lower lows, or we can keep breaking structure to the downside, the market is still going down. But a time will come when this market will do something like this, right? We trade towards the downside like this, right? And then remember, this low here should be the target liquidity, right? But it failed to pick out the target liquidity, right? And stop somewhere here, and then turn and now start trading towards the upside, something like this. So you notice this is the first time. Let me stop here for now. So you notice this is the first time we are having a low that is not lower than the previous low, right? This is the first time we are having a low that is not lower than the previous low. That means this movement, right, has failed to take out this low, right? So that means there is no break of structure to the downside. So, but guess what? The So it means there is no break of structure to the downside, right? There is no break of structure to the downside. So the market will now move up. Sorry. So the market will now move up something like this, and then and move higher, right? Higher than this high here. So this is the first time we're experiencing a break of structure to the upside. I mean, it is the structural high, right? We are experiencing the break of structure at the structural high, not at the structural low, at the structural high. So let me draw something like this. So this is the first time we are seeing the break of structure, right? And it's happening at the structural high, something like this, right? So take a look at this. Now this is where we're experiencing the shift. But take note, the first thing we saw was that it failed to go lower than the previous low. The break of structure did not happen at the low. The break of structure happened at the structural high. So once this happens, it means that the buyers are gradually coming into the market, because you notice up here is supposed to be the protected liquidity. But guess what? The market took out the protected liquidity, and this target liquidity is now being protected. So once there is a break of structure also to the upside, the next thing we expect is a retracement. So the market retraces or dips into the downside like this, and usually once it goes below this break of structure, and of course below 50%, that is considered as a discounted area, right? That means you can now buy. So this is where, if you want to trade the reversal of the market. So this is the acceptable region where you can do your buy trade, right? So you can buy around there. So if you buy around there, then you expect that, of course, if you buy around there, your stop loss should be below this level, right? And you take profit, you target here. But guess what? Since you're already trading this, it means you can stay longer on the market. So for swing traders, you can enter here and stay as long as you want on the market until there is another shift in character on the trend. So from here, the market can push up to the upside, something like this. And now if you notice, now we have shifted from the downward trend to the upward trend, because right now the break of structure will only be happening at the structural high, and then the protected liquidity will now be at the lower side. So we have shifted, right? Technically we have shifted, right, from this downward movement to this upward movement. So from here, the price pump again to the upside and break structure to the upside. So let me now switch over to the chart very fast. Now on the chart, let's look at how market structure analysis works on the chart. Okay, so I'm going to use this USD IDX, that is USD index, for my explanation, and this is H4 time frame. So if you look carefully, trying to do this very fast because of time to make the video very short. So this is where the price moves downward, right, to create a new low, to create a low. And from there, the price retraces upward, right, towards this point. Now this becomes our structural low, right? Now for the price to continue downward, it has to break the structural low, and that's what we call break of structure. I hope you don't forget break of structure. So immediately this price start moving downward, so and moves below this low, we call that a break of structure. So it moved downward up until this point, right? And remember, after you see a break of structure, we normally look out for a retracement to the upside for a downward trend. So after that, it retraces to the upside. Now this retracement should not go above this high that broke this structure. So this high becomes our supply zone or our strong resistance, right? Strong resistance. So if this price should retrace up, 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 and finally move above this high, that is what we call shift in the market direction, right? So you keep an eye on this high here, right? Because once the price goes above this high, then you want to change your mind that the market is no longer going down, it's now going up. But guess what? See where it stopped, right? Which is a good point. See where it stopped. Then remember, this is where it stopped, right? Then of course from here it now started going down. Remember this high, for this high to be a strong high, right, or a verified resistance, it has to break a structure. It has to break this structure. But guess what? See where it came? It came down here. It came down here, and then okay, let me do this. It came down to this low, it gave us this low. So you agree with me that this low is not lower than this. Let me show you real quick. You can see that, right? That this low is not lower than this low. So it's almost giving us a relatively equal low, just like I explained on that other part, the first part, relatively equal low, right? And of course, once you have a relatively equal low, let me draw a line there to show that this is actually relatively equal low, right? So you can see that the market gave us relatively equal low. So one of the reasons why this market like giving us relatively equal low, number one, is for the purpose of accumulating trade, right? It can accumulate a lot of stop losses at that point so that it can go back to take out those stop loss. We call it liquidity, okay? So that means at this point, like I explained earlier, traders looking at double bottom here, right? Or relatively equal low, they'll be thinking about buying, right? And of course, if you buy, the market move up, you make profit. But most persons want to stay longer, right? Forgetting that this is a downward trend. So whenever this market creates relatively equal low, that becomes the next target, and I call that targeted liquidity. So the market will be targeting this point, okay? So but don't forget, this low is not actually lower than this, so it retraces upward, right? Because we are looking for a movement that will actually take out this low. So this high is still in force to break out this low. So the next time it moves down, you can see that it actually took out this low, right? So right now, this is the high. Don't forget, it is not this high, right? This is the high. So everything that happens inside here can be termed as internal structure, right? So on its way to take out this low, to cause this break of structure, it has to do all of this, right? So these are the internal dribblings that normally confuse traders on the market. Okay, so now this high is the high we are now focused on, right? So if the market retraces upward, right, even if it gets to this or this other high here, right, and even goes above this high, it is not considered shift except it goes above this high, because this is the high that actually took out this low. Okay, so now we have gotten another break of structure again. Don't forget, this is a break of structure. If I may extend this thing, this line to this point, this is the break of structure, right? So we are expecting another retracement to the upside. So see how much it retraced to the upside, right? And then it pumps down again to the downside. Can you see that? It comes down again to the downside, right? Then this how much it will trace again to the upside. So once you have this in mind, of course trading becomes very easy, right? You just now this helps for your directional bias, right? Having a bias of which direction the market is heading to, right? And once you have this, of course, you will not be confused. Once you have a directional bias in place, every day you will know the direction the market is heading to. Okay. Now from here, you can see that the price moved down to this level, right? So if you check it very well, again, this becomes another relatively equal low, right? Comes another, okay, this low appears to be lower. Fine, that is good. So this is another lower low, right? Then from here, so this is another lower low. Then from here, right, the market pumps to the upside. Now you notice that this price actually came up this much, right, which is lower than this high that took out this low now and went higher. That means there is a shift in the market direction. See where the shifts are happening, right? So just immediately the market shift to the upside, then it later move down again and shift to the downside. So that means that one trade still continues, right? So if you watch carefully, you will notice this long movement here is a fundamental event, right? And fundamentals have no respect for technical analysis. So this is fundamental. That is why it still have to shift. That means it was actually targeting to take out all of these buy stops that will be up here. Okay, so the downward trend still continues. That's what it means. So then from here we saw another retracement. So this is how it's being played out, right? So you can see clearly that the market keep rocking and keep going and keep trading lower and lower and lower like this. Now up until, let me jump to where I will show you a shift again in the market structure, right? So from here, please, this is a USD index, right? So as long as all of this the price is going downward like this, it means you want to be selling all the USD anywhere you have USD as the base currency. You want to be selling that currency base. Something like USD card, you want to be selling it. Something like USD JP, or want to be selling. So you want to be selling USD, right? Something like anywhere you have USD as the denominated currency, I mean the second currency, the quoted currency, you want to be buying. Something like JP USD, you want to be buying JP USD as long as this chart is going down. Something like Euro USD, you want to be buying, right? Then watch carefully again. Now this is the high that broke this low. Now this time around the price pushes up and went right and broke this structure to the upside. That's what we call shift in character, right? So this is a shift, right? So after that shift, we expected a little retracement, and of course it gave us that retracement. Is it not true? Then from here the market start pushing upward. So once you understand this, you know the direction the market is going. Then from here, of course, you know you have to now start buying and buying USD on the long term. So this analysis is fantastic for swing traders. You are a trader, you're very busy, you don't have time to always be checking the chart. Of course, you can do this analysis and then return back to your other instrument that has USD in it. And of course, start basking and start doing very well in this business. So let me run fast again and show you how there was another shift, right? At this point again. So if from here it retraces again to this downside, and then the next time it pushes up, it took out, it was able to take out this high, right, to form a new high, right? So this becomes a low. The next time it pushes down. Now of course, we not expect it to go lower than this low, which is good. Now it pushes up and gives us a high that is almost equal to this high, and that is what the market always does, right? To trap traders. So the next time it comes here, of course, to be targeting this relatively equal high, right? So the next time it pushes up, so you can see it came down again. It formed relatively equal low here. Oh, this is so fantastic, right? Technical analysis is so sweet, I can tell you that. So this is so fantastic. So see, it gave us relatively equal high and gave us relatively equal low. Now whenever the market gives you these two, take note, the market will be going for the two, right? the market will be going for the two. The market will be going for the two. The market will be going for it. So I've said this several times. So please, this is one area where you can make a lot of money trading on the global financial market. Once you can see two relatively equal high at the upside, relatively equal low at the low side, wow, that's fantastic. But guess what? Remember now, the question will not be how do you know which of them the market will be going for first? Most person want to ask, Emmanuel, how do you know? So once you have two equal highs and of course two equal lows, most often than not, the market will most likely go for the market will most likely follow the structural movement, right? Or the trend. And of course, the trend is upward, right? And whenever the trend is upward, the targeted liquidity is always at the highs, right? And whenever the trend is downward, the targeted liquidity is at the lows. Right now, can you guess where is targeted liquidity? This is upward trend, as you can see here, right? The market is trending upward, volume is pushing to the upside. That means this area up should be targeted liquidity. So if you notice carefully, the market first took out these two equal highs, which is like a magnet for the market. The market is always attracted to it. So it took out these two equal highs and of course gave us a new high here. Now guess what? After that, the market quickly came down, right? To take out the two equal lows. I told you that whenever the market creates this equal high and equal lows, the market normally goes out for it, right? And just spotting these two equal highs, two equal lows on your chart, you can make enough money with it. So the market took out these two equal lows again, right, to give us a new low here. Now take note, so many things has happened for the market to take out these two equal lows. It means number one, it has taken two equal lows, it has grabbed liquidity from here. Then number two, there is now a shift in the market direction, right? So the market have shifted from up to down. How do we know? It has broken structure to the downside. That's a change of character, and whenever that happens, we normally expect a retracement again, right, for profit taking, retracement to the upside. Then for there, as you can see, the market start trading lower, of course, and lower. So from now, as you can see right now, you can see that this USD index is actually trading to the downside, right? So let me jump into another chart and show you this, right, how it works also on another instrument. So let's do maybe Euro JPY on the H4 time frame. Let me show you how it works again on the H4 time frame. Now you can see clearly that once you understand this, the way the market structure, you do well, right? So let me start from just a random point. So you can see here that from here the market was trading lower. How do I know? It pumps to the low side, right? And then of course it retraces upward. So then the next time it moved down, of course the targeted liquidity is down for a downward trend, so it pumps lower, as you can see, right? Then okay, let me take this low. Then from there it pumps or it retraces to the upside. So you can see this, my drawing clearly shows that we are already breaking structure to the downside, break of structure, right? The next time it pumps down again. If you notice carefully, this price moves lower, this price moved lower than the recent low, right? It moved lower than the recent low. So there's a break of structure to the downside here. There's a break of structure to the downside here. All right, so then from there, the price moves upward. So this price moving all upward is actually a break of structure to the upside here, right? So, and break of structure to the upside there is what we call shift in the market direction. So the market have shifted. So this is where we experience the shift, right? This is where we experience the shift. So when we experience that shift, we normally look out for uh, a retracement. So you can see how deep this retracement moved down, right? The retracement deep very well. But you notice that this retracement did not go lower than this low, right? So that means this bottom here has become our protected liquidity. Okay, so from there it pumps to the upside. Then from there we have been seeing this Euro JPY on the H4 time frame trading to the upside. So for a swing trader, this is around this point is when you now start taking your buy and of course riding this upward trend for a longer time. Okay, so you can see after it trades, after it moved up, right, and gave us a break of structure. So this is where it gave us the break of structure, right? break of the structural high, right? That's what we call break of structure, break of structure. Then from there, it retraces a little bit lower, which is retracement we always expect on the market, right? So this is where the more market gathers more momentum to start trading again to the upside. So from here, it pumps again to the upper side. So you can see how long it stays. So in reality, if the market is on an upward trend, it trades more or it stays longer on the impulse leg. So this is an impulsive move here. It stays longer on impulsive move than when it is retracing. So it retraces just a little bit here. So right, so this becomes a new low, right? Then from there it trace up to cause another break of structure to the upside. So right now what we're seeing on Euro JPY is only giving us that temporary retracement to the downside, right? So probably it will retrace to somewhere around there before we can now think of buying again and start trading into the upside. Okay, so I've showed you Euro JPY. Let me now show you another instrument, AUD USD. Now the reason why I'm showing all of these different instrument is to show you that once you understand the structural analysis, you will do well trading on the global financial market. I can tell you that you will do very well trading on the global financial market because it works. It really works. So this is how the algorithm that runs this market. This is how it delivers prices. Okay, so once you understand that language, of course, then you will do well. So now, by just looking at the chart, it may look confusing, right? But guess what? After you must have used lines or by just looking at it, itemize where all of the break of structure has happened, you will notice that everything becomes very easy. But just looking at the chart, you will be confused. Now, let me use my line and try to make it to look easier. Okay, so from here we saw that the price trade lower to this level, right? Then from here it traced higher, you know. Then the next time it moved down, if you notice, it did not go lower than this level. So you notice, so this area, so what we have here is relatively equal highs, right? Relatively equal highs, you know. So, and of course, this high becomes the highest point of the market, right? So until it gave us this low, right? So all of this movement can be termed as internal structure because this low have not been taken out. This low has not been taken out, right? So it gave us this high. So it was this high that finally took out, it was this high that finally took out this low. So this high becomes our new high, right? So this is where it took out the low to, because we saw another retracement again to the upside, right? We saw another retracement again to the upside. Then from here, it pumps again to the downside, as you can see. So this is a characteristic of a downward trend. So whenever you see this, your directional bias would mean to be selling on the market until you experience the first break of structure, right? I mean shift of character, right? Or break of structure to the upside. Now see it retrace lower, as you can see. This is break of structure to the downside, break of structure to the downside. That market is going down. So this is the first time we're experiencing a shift. See how much see how it occurred. The market trade up and move higher than this high, right? Towards this high. So this is the first time we're seeing a structural high that is higher than the previous high. All along we have been seeing structural high that is lower, lower, lower. Now this is the first time we're seeing a structural high that is higher than the previous high. And when we cite that, we wait for retracement. After that retracement, this is the best spot to start riding the trend to the upside. So this is the best time to take the buy. So around this area is where you can do your buy, and as you can see from that area, the price pumped to the upside. Of course, that would have been profit for you. Then from there, it breaks structure again. After every break of structure, we normally expect a retracement to the downside, right? So right now, it has retraced very well because this one has gone below 50%. Let me zoom into the area. This movement has gone below 50%. So now you can see the price is trying to pump again to the upside. So my prediction for this AUD USD is that this price will pump again to the upside and break this structure again, right? So that's a sign that it's going up, right? So I can even pick a trade here because I'm already seeing that it's going to the upside, right? So this is how the structural analysis works, right? So I hope you have been able to get some value, right, from this structural analysis, right? So please, this is Emmanuel Udogo on this MRS Trade YouTube channel. Please do well to check back again, because I know I constantly upload more new videos. Okay, now if you have not funded your account, why not? What are you waiting for? Get an account funded, because with all of these juicy and very easy strategy to understand the market, and I can assure you that you will do very well trading the global financial market. Please do well to subscribe and also like and share this video. Okay, bye for now.